Awesome. All right, we're going to be talking about coping with margin calls today. Too many traders that I run into, especially futures traders that aren't familiar with option trading, they kind of have this idea set in their mind that if they get a margin call, there's only two ways to handle it. Either send money or get out of a trade. And I'm here to tell you that there might be a couple other things that you could do. I'm not saying, if you get a margin call, I'm not saying I can magically erase the trade that you did or anything like that. But what you can do is you can kind of adjust your margin requirement through the use of options. And so we're going to talk about that today. We've already kind of mentioned this, but it's my job to make sure you fully understand that there is substantial risk of loss in trading futures and options. We have a lot of rules and regulations we have to follow, and we want to make sure that you understand anything that we talk about here. They're ideas, and there's no holy grail. Trading has risk, and hopefully we can give you all the information we can to possibly put the odds in your favor, but we're not necessarily investing, we're trading. Anyway, here's my contact information. My name is Carley Garner. If you have any questions or comments or concerns about anything we talked to today or about trading commodities in general, that's how you get a hold of me. If you're on Facebook and Twitter, look us up. And if you're interested in learning a little more about trading commodities or options on commodities, go to DeCarleyTrading.com. We have a lot of free videos, articles, things like this. As Dan mentioned before, I've written a couple of books. Trader's first book on commodities, the one in the middle here, actually we just released a second edition. It was almost completely rewritten to updated for technology, trading platforms, all those types of things. So if you're interested in that book, make sure you get the newest edition. The newest edition is blue, and it's my fault for not updating this picture, but look for the blue one. I'm going to zip right through here, but you may have seen me in Stocks and Commodities. I also write a couple of client newsletters for our brokerage clients that are free of charge for them, the DeCarley Perspective and the Financial Futures Report. But we're kind of short on time, so I'm gonna talk about some of these things that you might already be familiar with. However, I'm going to do it rather quickly. I'm the type of person that, I have like a flow, and I can't start the story in the middle, so I have to go start at the basics and then move from there. So we're going to talk about first, what is margin? Well, margin is a specified amount of funds stipulated by the exchange, and that's important. The exchange is the entity that sets margin limits. Now, your brokerage firm can charge you more than the exchange is asking, but they're not going to ever be able to charge you less than the exchange is asking. At least not for positions that you're holding overnight. And we'll talk about the difference between day trading margin and overnight margin real quickly as well. But basically, margin is a good faith deposit. It's ensuring the exchange that you have the ability to meet your obligations of profit and loss, and that others will also be able to meet their obligations. In other words, this is really what makes markets work, at least the futures markets. If we weren't required to put margin down, it would be almost like, remember the housing market, 2006? People were buying houses with no down payment. That's what it would be like if there was no margin required. People would put their bets on, and then if it didn't work out the way they wanted, they might just walk away. So luckily, the exchange does charge margin. And the reason the exchange charges margin is because all U.S. futures exchanges guarantee every transaction that takes place. If you buy or sell a commodity, the person that takes the other side for some reason can't live up to their end of the bargain, the exchange makes sure that you get paid what you're deserved or what you're owed based on your profit and loss. And again, if there really wasn't margin, there wouldn't be an exchange guarantee, and if there was an exchange guarantee, probably none of us would be here talking about these things today. Let's talk about the difference between initial and maintenance margin. Again, this is kind of basic. A lot of you probably are familiar, but again, I like to make sure we cover everything just in case some of you don't know. There's two types of margin requirements. There's an initial margin and there's a maintenance margin. The amount of money that is required to be on deposit to enter a trade is the initial margin. The maintenance margin is really what you have to have on deposit to keep the trade on. Once your account falls below the maintenance margin, you're required to bring it above initial to eliminate the margin call. And like I said, as a futures trader, a lot of people think, Well, I'm short $5,000 in margin, so I can either exit $5,000 worth of marginable trades, or I can send 5,000 to my broker. It's not, I mean, those are simple solutions, but there's other ways to go about it. Instead of changing your, the amount of money in your account or the positions, you can actually change your margin by buying and selling options, and we'll go over a few examples. A lot of people assume that if you're on a margin call, you're going to get a phone call and somebody's going to give you the specifics, and that might be true. If you're working with a full service broker, he's probably going to either email you or call you, let you know the situation, maybe give you a few ideas on how to take care of the situation. That's typically what I do for my clients. I'll say, look, you can sell this option, you can buy this, and I give them a few ideas. It's, but obviously it's up to them. A margin call might also, it might not be a phone call or an email at all. If you're trading self-directed online, without any specific brokerage help or anything like that at a discount brokerage firm, you're probably just going to be on your own to look at your statements, and from there you're going to have to be able to determine whether or not you're on a margin call. And if you happen to, for whatever reason, miss the fact that you're on margin call, don't be surprised if somebody comes and liquidates your account after a day or 2 or 3. Day trading versus overnight margin, and there is a big difference. Overnight margin rates is what we were originally talking about. When we talk about initial margin and maintenance margin, those are the overnight rates. Those are the rates that are set by the exchange, and they require you to have on deposit to hold positions in their markets. The initial and maintenance margin are measured one time during the day, and it's at the close of the trading session. Day trading margins, on the other hand, are set by your brokerage firm. Some brokerage firms offer ridiculously low day trading margins, or at least they advertise that. They'll tell you you can come in and you can trade an E-mini S&P for $300, $400, and it sounds fabulous, right? I mean, you could open a $1,000 account and sell 3 E-minis, but it's not quite that simple. Firms that are enticing people with this type of thing, it's almost like a cigarette company that's selling cigarettes. They know that their product is not good for the consumer, but they're making money, they're marketing, they're doing what they need to do to bring revenue in. And that's kind of what a firm that pushes very low discounted margins like that, that's kind of what they're doing. They know that the chance of you making money when you're using that kind of leverage, $300 to trade an E-mini, the odds of you making money are slim to none. And they know that. I'm not, maybe they care, maybe they don't, I don't know. But just know that going in. When you're talking about day trading margins, they can go really, really low, but it's not always in your best interest. That said, I would say most firms probably do about a percent, like 25% of the overnight rate, and of course that varies based on what the overnight rate is that the exchange settles. But what you need to know here is day trading margin rates can be very, very low compared to overnight rates. Day trading are set by the broker, overnight rates are set by the exchange. The margin call countdown. A lot of people are really unfamiliar with how much, once a margin call is triggered, how much time they have. And I'll tell you this, it really depends on which brokerage firm you're using, who your individual broker is, all these types of things. There's not really a black and white answer. But what I can tell you is here's kind of the lay of the land. The amount of time given to bring an account into margin varies from firm to firm, but it's usually 1 to 3 days. Day 1 is kind of like a friendly reminder. It's warning you that you're maybe trading a little beyond your needs, and it's a freebie. Some firms nowadays charge margin call fees, so if you're on a margin call beyond day 1 or whatever, they'll start charging you fees. Usually the day 1 is a freebie, no fees. There's typically no forced liquidation, but you really shouldn't be adding to your positions. And again, these are in general. Some brokerage firms are a lot stricter. I know of some brokerage firms that will actually liquidate your account on the close of the previous day. They don't even want to ever risk anyone ever getting a margin call, because they'll go in and just force liquidate your positions. And I'm not saying that's right. I'm just saying that these types of things are out there. So you really need to make sure when you're researching a brokerage firm, you need to know who you're dealing with and what the policies are and things like this. I am a broker, I should have been a little more open with that in the beginning. I am a broker, so I've seen this from both ends of the spectrum. With that said, I mean, we typically give people as much time as we can, but at the same time, as a broker, we're accepting risk in our client accounts. Like most people don't realize this, but if you're, as a client of a brokerage firm, if you lose more money than you have on deposit, it's the broker that has to pay for that until you can come up with the money to make it right. And so, with that being said, depending on who you're working with as a broker, they may be, they may be on you minute one and pressing you to send money because they don't want your mistakes to eventually come out of their pocket, and it does happen. My general recommendation is you really want to try not to let a margin call go beyond a day one. I mean, it happens. It's not the end of the world by all means, but you want to try to at least take some sort of action, and that might be adjusting your trade or adding a little money or whatever it is on day one. Day two will probably, I shouldn't say probably, some firms it might involve fees. It might involve a lot of pressure from the margin man, from your broker, things like that. But you really should be, you're going to be expected to take action on day two. You really do not want to add to your positions. It's just going to put you on the, the radar of the risk department and on their bad side, and that's not where you want to be. Day three, once you start getting into the day three area, you're probably facing, again, this is depending on brokerage firm, but most firms will not allow you to go beyond a day three. So you're probably looking at forced liquidation, these types of things. And trust me, you never ever want to go there. Risk managers aren't concerned with timing or price. All they want to do is get your account within margin. They don't care, what's going on. You want to be the person in control of your own destiny. You don't want the margin man to tell you when you're getting out and how. Okay. Adjusting risk, delta, and margin. This is probably what you're all most interested in. We're going to talk about how to alleviate a margin call without sending money and without getting out of your trades. Most of you are probably aware of what delta is, but here it is. Delta is the percentage in price change of a position relative to the change in the underlying futures contract. The delta of a futures contract is 1. So knowing that the delta of a futures contract is 1, we know that the delta of most options, in fact, almost all options, are less than 1. The delta of your position is going to be the net of your futures position and any options that you have correlated to that position. So you can reduce the delta of your futures through the purchase or sale of antagonistic options, and what that means is going in the opposite direction. If you buy a futures contract, you can sell calls against it. You can buy puts because those positions are going opposite to your futures trade, and it actually lowers your delta. The higher position delta you have, the higher the risk and the higher the margin. So the goal in using options to lower your delta is to use options that are going to benefit from the opposite of what your futures are. Let's get into a little more detail. A trader that's long a futures contract, they could do two things, or they might even do both. But you could buy a put option. A put acts as an insurance policy. It limits the risk absolutely in the amount of premium paid and the difference between the strike price and the entry price. And I know that's real confusing and hard to digest in a sentence. So I'm going to show you an actual example in a second. But just know that you could buy a put option against a long futures contract. Those two positions go in the opposite direction, right? A long futures contract, you want the market to go up. If you're long a put, you want the market to go down. So they work against each other, but your primary position is the futures. You want the futures position to win. The put is just there in case you're wrong. Buying a put decreases the delta because it makes money as the market drops, which is the opposite of the futures contract. And you could kind of look at it mathematically by taking the futures delta, which is 1, and subtracting the put delta. And we'll show you kind of an example of that, and it'll sink in a little easier than it is just reading it on a screen. If you're long a future and you sell a call option, this doesn't limit your risk, but you know what? It takes the edge off. It kind of gives you a buffer in your risk. It reduces the margin because the cash that you collect by selling the call option actually goes towards your margin requirement. So it helps your margin in two ways. It reduces your delta and it adds cash to the account. And this is kind of, we'll call it delta math. If you're long one futures contract, remember the delta is 1, and you sell 2 call options that have deltas of 30, meaning, and what a delta of 30 again means is for every 1 point that the futures market moves, the option's going to move 30% of that, is basically all it means. So if you sell 2 calls, each with a delta of 30, your option delta is 0.6 and your futures delta is 1, so you know that your position delta is 0.4 or 40%. So in other words, instead of being long one futures contract in which your delta is 1, in other words, if your delta is 1, you make or lose 1 point in the option or the position with every point that the futures moves. If your delta is 40, you're only going to make or lose 40% of what the futures market moves. And you can see that this is a tamer position. It'll have, the position itself will have lower volatility, and it's going to qualify for a lower margin rate. Not to mention, you collected cash when you sold the options, and that cash collected adds equity to the account, and that is used towards margin. For the sake of time, I'm going to kind of just breeze through this, but the same idea holds true to somebody that's short a futures contract. Instead of being long, this person's short, so you could buy a call as an insurance policy against your short futures, or you could sell a put, or you could do both. You could always buy the call and insure yourself on the upside, but buying a call costs money, right? Options aren't expensive. It's like insurance. You have to pay for it. You could sell a put to help you pay for that call, and you could put together what's known as a caller. So there's lots of possibilities. Let's take a quick look at an example here. I know we only have about 5-10 minutes left, so I want to make sure we get through this. The current margin on crude oil futures, and this is a full-size future, is 2,800, well, 2,805. And why in the heck, they add the extra $5, I couldn't tell you. But, why waste any time wondering? It's 2,805. So let's assume that a trader is short a couple of, well, let's just say we're short one. We'll just, for simplicity, let's say a trader is short 1 crude oil future and they're on a margin call. If they're on a margin call, this means their account probably only has about $2,000 in it. That would put it below the maintenance. But for, my advice is you probably don't want to be selling crude oil futures with a $2,000 account. You could, and it might pay off. You might double your account in a day or two, but you might blow it out in a day or two too. So just know that. But anyway, this is an example. So you're short a crude, you're on a margin call. There's a couple things you could do. You could get out, or you could add, you could wire a couple thousand to hold the position, or you could do something like this. You could sell 2 of the 82 puts. I don't know if you can see my cursor or not. I'm assuming you probably can. But anyway, this blue line towards the bottom, that represents the $82 mark in crude price. So you could sell 2 put options with a strike of 82 and collect 80 cents a piece. And what that means in real money is $800 per option. You sold 2 of them, so you're bringing in about $1,600. So instead of exiting the position, you're bringing in $1,600 in cash, and that $1,600 in cash basically gives you a buffer above the market. So now it almost adjusts the sale price of your crude oil future higher by $1.60. And that's because you're collecting a total of $1.60 in premium. So instead of your entry price being about 91-ish in this example, it's really about 92.60. based on when you're talking about break-even calculations at expiration. So not only does it give you a buffer on the upside, but it brings cash in the account. It reduces your margin to about $1,000, and it really doesn't cause any harm on the way down unless the bottom of crude oil just completely falls out. But it would take a pretty big move. First, let's kind of get an idea of what that would do to your delta. Remember, if you're short 1 crude oil future, your delta is 1. But if you sell 282 puts, you bring in $1,600 total. You can see the delta here on the right hand side, the blue column kind of highlighted in red. It says the delta per option is about 15. So you're selling 2 of them, which means you're lowering your position delta by a total of 30. So instead of your delta being 1, it's now going to be 70, which means your position's only going to move about 70% of what the underlying futures moves. Okay. In this example, a person, again, we were short a crude oil future. We sold 2 puts with an 82 strike price to reduce the margin limit. Now, what this does is, some of you might be saying, well, that's great, but if the market goes down, then you're short two puts and you're going to be in trouble. And that's true to a point, but really what it does under most circumstances is it limits the ability to make money on the downside below 82, but it would take a pretty substantial move for it to actually get you into a lot of trouble. And here's kind of how the math works out. If you sell a futures at about 91, again, we mentioned your break even is above that. It's about 92.60 because you collected a little extra premium, so your break even's all the way up here. So as long as the market's below 92.60, you're pretty much going to make something all the way down to 71.40, all the way down here, and we'll show you how we get that. Okay, from 91 to 82, which is the strike price of your option, you're making money on the futures contract. In fact, you're making about $9,000. Once you get to 82, it's true. If the futures price continues to drop, you're not making any more money. In fact, you're giving your profits back. From 82, sorry about that, I lost my cursor. Anyway, from 82 down to about 73, you're going to be giving your profits back, but you're still making money. Once you get to 73, you're out of profits on your future, but remember you still collected $1,600, and so you still have that as a buffer. So that puts you all the way down to 71.40. So not only did you get yourself off of margin call, you collected an extra $1,600 and gave yourself quite a bit better odds of making money should the market creep up a little bit. But you really didn't hurt yourself on the downside unless, we see some sort of crazy scenario in crude, which could happen. We all know that anything is possible in crude, but it's probably not. I would say in this particular trade, it's pretty fair to say that move to 82 would be fabulous. Anything beyond that, it's pretty unlikely. It could happen, but it's unlikely. So this type of trade helps you out margin-wise. It gives you better odds of success, and in my view, really is just a better way to go about it as opposed to selling future and just hoping for the best. So in conclusion, margin calls are going to happen. Even if you trade responsibly, they're going to happen. Sometimes, you get crazy events, debt ceiling debate, something crazy in Washington, who knows, but sometimes things happen and you're going to get a margin call and you're just going to have to be prepared to deal with it. Don't let the emotional turmoil of having a margin call get to you. It happens. It's not the end of the world. You can usually adjust things and work your way out of it. Also, don't take your brokerage firm's request to bring the account within margin lightly. You really don't want others, meaning the margin department, the risk managers, determining the exit point of your trades, because like I mentioned before, they're not concerned with price, timing, they don't care. They just want you out. You want to do it on your own. Well, I want to appreciate the time I've had here. I will make way for the other speaker. It looks like I'm just about out of time. But I thank you for attending, and again, if you have any questions, comments, or concerns, here's all of my contact information.